Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. From cash transactions to checks, to debit and credit cards, to net banking, mobile banking, and then digital wallets, the way we transact and deal with money has gone through a sea change over the last 1 decade. One thing is clear, digital is here to stay and it's growing by leaps and bounds. So you may as well get a little smart about the best way to use this medium. And helping us do just that on the show this week is Deepak Chandnani, the South Asia and Middle East CEO of Worldline, which is a global player in the digital payments processing industry. Hi, sir, and welcome to the show. It's great to have you here. Digital and money and this fusion of the two that's happened over the last couple of years. It's very interesting. It's very convenient. But it's actually also getting very confusing, which is why we thought we'll have you here to try and understand what is really going on. So I want to talk to you about the way payment is changing and what we should be geared up for.
Hi, it's a pleasure to be here. Indeed, it is confusing. It's not only confusing to the man on the street, it's confusing to all of us who are in the industry as well. And a lot has changed, as you mentioned. At the heart of it, if you look at how payments happen, and as a consumer, there are basically 3 payment instruments. There's your bank account, there's a credit instrument like a credit card, and there's a prepaid instrument, which used to be in the old days traveler's checks, now got converted to plastic and so on.
So it's a travel card,
it's like a travel card, for instance. So these are 3 basic payment instruments. Now, all that you talked about is the various channels and methods by which these payment instruments are now accessed and used. So take your classic bank account. In the old days, we used a checkbook. We signed a checkbook and we needed cash. We'd walk to the branch and fill up a little form and collect cash. You don't do that now. The ATMs came in first, so you didn't go to the branch anymore. You got debit cards. So with debit cards, you can now shop at a store. Then came internet banking and mobile banking. So you don't need to write any checks. You still can, but you don't need to. So suddenly, what was the standard bank account, which had checks, and then you walked into a branch, has now become debit cards, mobile banking, internet banking.
Sure.
So those are all the new channels that have come into place. The old channels still exist. Similarly, when you look at a credit instrument, in the old days, you went to a bank and borrowed money. Then came charge cards, which were like Diners Club. And after that came credit cards. And credit cards come in the form of plastic, as everybody knows. But now credit cards are also something that you can use in your phone. So you now have a new channel to use your credit card on the phone. And of course, you can use a credit card on the internet using your PC to buy things from all the e-commerce sites.
Absolutely.
So again, the channels have changed and there are different ways in which you access the credit your bank gives to you. And then you look at prepaid instruments, what used to be paper traveler's checks, that became cards. And it became different types of cards, gift cards, international travel cards, and now the latest avatar is wallets.
So we're going to spend some time talking about wallets in more detail in just a bit. But we're going to talk money because this is money, money, money. And the Indian consumer is very, very conscious about getting the maximum bang for his buck. So let's talk about the way we transact, let's say, on internet banking or the way we transact over mobile. Nowadays, for instance, we are seeing a lot of sites levy the so-called convenience fee. And it's interesting because the government is in the process of phasing out all kinds of fees and surcharges, etc. on digital payments because the government wants us to transact more digitally. But at the same time, fees, charges, surcharges, and some of these levies continue. So is digital really efficient?
It is. And so let's look at what a merchant has to pay when they accept a card, for example. So it's called a merchant discount rate or a merchant fee. Typically, it varies from 1.6 to 2.5% in that range. That's what the merchant pays. But that's for credit cards. For debit cards, it's already been reduced. And depending on the kind of debit card, it's down to below 1%. So therefore, the merchant pays much less of a fee to his bank when he accepts a debit card as compared to a credit card. And as we move forward, and as merchants use cards more and more and their credit ratings with their respective banks go up, these fees will reduce further for them as you move forward.
But as of now, surcharges are being paid by the consumer.
Yes, that's true.
And not the merchant. So that's the add-on that you're paying on every transaction that you're doing.
That's true. Because what the merchant is doing is whatever he has to pay his bank, the 2.5% he's taking from you as a consumer, right? Because his own margin he's trying to protect, because his margin is probably very thin on that particular item he sold to you. So as we move forward, we'll have to find a mechanism by which the merchant can afford to pay that fee to his bank to accept your card. And as we go digital, I think the objective is that everybody wins.
Okay, all right. We're going to take a very quick break on that note. But on the other side, this is the era of mobile wallets. We're going to talk about them and what next in the digital payment landscape. Stay right there.